Kritika.
Hello, ma'am.
Yeah, hi. Tell everyone to join.
Yeah, I'm texting on the group.
Yeah. Hello, Dr. Goswami. Good afternoon.
Hi, Bhagyashree. How are you?
Hi, I'm good. I'm good. Thank you for being with us this afternoon.
Thank you very much. Happy to be here. Okay.
Yeah, good to see you. Hi.
Nice to see you. Hi, I'm Alex, right?
Yeah, hi Mangal, how are you?
Hi, nice to see you also. Thank you. My apologies for not being in touch. It's been a very tough few months, and then I went on a bit of a leave. But I'm back in business, so hopefully we can catch up soon.
Absolutely.
Let me extend a warm welcome to all those who are here, and of course to Dr. Goswami for being with us this afternoon in spite of his extremely busy schedule. I don't know how to thank him for accepting this invitation. Yeah, and you all are aware he's going to talk to us on capital flows of emerging markets, especially in the current geopolitical situation. But before I hand over the session to him, let me briefly introduce all of you, Dr. Goswami. I mean, we are lucky because as I told students also, and Tushar also kept saying that you cannot have a better person than him to talk on this topic, especially because he's in touch with all the governors of the central banks of different countries. So, I mean, when I came to know this, we really got very excited about it. So, friends and students, Dr. Goswami is currently ex-director at SIASEN, that is Southeast Asian Central Bank's Research and Training Center in Kuala Lumpur, Malaysia. So he has joined us from Malaysia, of course. Earlier to that, he had a long association with IMF, and he was a deputy director at IMF South Asia Training Center at Delhi as well as at Singapore. He has been a member of IMF working groups during the global financial crisis. And prior to IMF, he was economist at ABN AMRO Bank in Singapore. So we are very lucky to have him with us. And I'm sure his insights are going to be very, very important and useful to all of us to learn from him. And I'm proud to say is also the board member of Meghnad Desai Academy. So that connection and bond is extremely strong. So I'm sure he will love to interact with the students of MDA. Thank you once again, Dr. Goswami, for being with us. Yeah, you may start.
Thank you, Bhagyashree, for that introduction. In fact, I'm still with the IMF, but I'm on leave from the IMF. Working as the executive director here at CSIN. As she pointed out, of course, we have the highest in our governance system. There are 19 central banks, and the board of governors consists of the 19 central bank governors. And we have a operational policy making committee, which is the deputy governors. So we have twice a year, we meet to have high-level policy seminars along with our overall operational meetings that we have close to. So yes, indeed, there is quite a bit of interaction, and we always keep up with the current issues that the CSIN jurisdiction, is the coverage includes. And I may say that, RBI is one of the biggest contributing members of the CSIN community. We also have PBOC China, then we have the entire ASEAN. We also have one or two small island countries, including the PNG, as well as we have Nepal, we have from the ASEAN region, from the South Asia region, we have Sri Lanka, we have Nepal. So it's quite a rich set of countries. That's why I think it's important to to understand the dynamics of all these economies and the challenges they're facing and what kind of policy issues they are confronted with, and what kind of going forward, what can help, because we are really at the crossroads of a very, very difficult situation right now. The fragile recovery from COVID-19 in itself the recovery was relatively fragile. It was one supply shock, and now we have another supply shock that's come upon us with the war and the geopolitical tensions. So we have two back-to-back supply shocks, and that has amplifies the situation of economic distress, and no matter whatever we talk about in terms of climate risk, sustainable finance, CBDC, central bank digital currency, crypto, and the likes, there is one topic that keeps governors awake at night, and that is the volatility of capital flows. And why is that? Let me move to my...
Dr. Goswami, just 1 minute. Is he audible to all of you?
No problem, ma'am. I think there is a problem on your side.
Must be then. Okay. Sorry then.
Okay,
Yeah,
no
please
worries.
go ahead.
I'll move my thing a bit closer. Let's see if this helps. Okay, is it clear now? Excellent. Okay, and feel free to turn on your video or your speaker and just interrupt. I'm not a person that likes monologues, and especially on a Saturday afternoon, when you probably were going to catch up on your Netflix or the likes. You have to listen to me on capital flows. So to make it a bit more interesting and exciting, I think it will be good if you interrupt me if you have any questions. I'd be more than happy to engage. So please feel free. You can see my slides, right?
Yes, we can see.
Yes,
You can see my slides. Okay, fantastic. So here, why did I say that, capital flows is sort of one of the key issues that policymakers are still confronted with? Well, the evidence was very clear when you dial back to early March in 2020, when the COVID shock hit the global economy. What you saw was heightened economic and financial risk because of the expectation that this kind of a massive supply shock would result in actually, deliberate sort of closing down of the economies, putting the economies on coma, because personal contact was not something that you wanted at that point. Therefore, everything as it was forced to shut down, you saw a massive supply shock. And in response to that, what you saw was one of the most deepest reversal of investor risk appetite and reversal of capital flows. And here we are mainly focusing on portfolio flows, and we'll talk a bit more about it later, but these are debt and equity flows that come into emerging markets to finance these economies. And we'll talk a bit more about the basics of that sooner than later, but I'm providing you with some context first, and then we'll sort of dissect this from the lens of from macroeconomic lens. So you can see that this is on the left-hand side, it's the emerging markets in total. They lost about, portfolio flew out to the scale of almost $100 billion. This is emerging markets put together. Yeah. And to the right, what you see is that the seasoned economies, including India, Malaysia, Indonesia, Philippines, and the likes, China, there the portfolio outflows were quite significant because they had received a lot of inflows before the crisis, and a lot of this money that invested in emerging market debt and equity started to flow out when investors sort of really, this is the new nature of volatility of capital flows, whereby investors invest in emerging market countries based on whatever it is, growth differential, interest rate differential, hoping that they'll get higher returns on their investment. But then suddenly, when the risk appetite changes, that can have a huge impact on capital flows, just like this one. This was not driven by any fundamental economic imbalance, but it was driven by fear that this money that has been invested will give you very, very negative returns. Therefore, people were pulling out of the emerging markets. Okay, so that was sort of a very, very solid evidence and reminder that capital flows are front and center. And for emerging markets, capital flows is a very, very important construct that all policymakers need to understand. Now, so fast forward to March, April 2020. Fast forward to March, April 2020. What are we talking about? We are talking about the fragile recovery, because the recovery was fueled by massive policy support, fiscal, monetary, financial, all kinds of policy support, right? Because people were out of jobs, banks could not, ask firms to repay their loans. The government had to sort of directly support the citizens who were sitting at home and could not go to work, and production had stopped. So all in all, across the global economy, there was massive policy support to provide a sort of a downside protection to the massive decline in output. And what happened was, not only were we doing the traditional pump priming or the traditional policy support with the expansionary monetary policy, expansionary fiscal policy, expansionary financial policy, but what was happening was, even central banks were very much engaged in this, where they went even further in many countries to do unconventional monetary policy, because they thought that especially in emerging markets, they thought that the state of dysfunction of the markets were so great that they had to actually intervene in the markets, especially bond markets, government bond markets, to provide some sort of a level of support. Of course, that sort of morphed into a bigger issue of some support in terms of the fiscal, whereby emerging markets typically, when they have moved from the crises era of 1970s, 80s, and so on, they say to themselves that in order to maintain anchor inflation, in order to maintain credibility of central banks will not finance directly any fiscal deficits. But of course, these times were very extraordinary. So some central banks got into monetary financing. And that is sort of a very, very big no-no if you were in the earlier stages of reforms of emerging markets. But this time was different, right? So overall, there was massive policy support. And what we see now is that on top of that, with the aggregate demand sort of again recovering, but at the same time, because of certain continued restrictions and the recovery of the production base, we have a massive positive shock from the aggregate demand moving up because of fiscal policy, monetary policy, right? Aggregate demand is recovering in a significant way, especially in the advanced countries. And then on top of that, you have these supply dislocations, supply chain issues. Therefore, we have an aggregate demand and aggregate supply mismatch, which results in higher inflationary pressures. And what we see in this graph here is that if we moved from the quadrant on the left-hand corner, where we have where output gap is quite negative. That means, overall, wherever the long run equilibrium of the economy is, aggregate output is much lower than that. So there are no, overheating pressures. We move from that to the rightmost quadrant, which is on the right side, where output is almost going above potential, the long run potential. And on top of that, we have the inflation gap has also closed. So therefore, we have inflationary pressures rising. And this is what we call internal imbalances are rising. This is, in economics terms, we call them internal imbalances. I'll go into this a bit more on the basics of this. So what we see after this massive policy support, especially in the US now, what you see is there was a massive fiscal support. And there was monetary policy was eased significantly, and financial policies were eased significantly. So you see inflation has gone way above. This is the first time inflation has gone to the level, it's first time seen since the oil shock in 1970s. So you have, the Fed sort of leading the charge on sort of making inflation a very, very big issue right now, because as we know, inflation is the biggest mandate for central banks, because if inflation is too high, then it can impact growth beyond a certain threshold. So what we are seeing, not just in advanced economies like the US, the narrative on inflation is becoming much more intense, right? You always, when you open the newspaper, you see that the Fed is talking about, how many more hikes will the Fed, come up with, because it has to stop inflation in its tracks. But part of this is also being driven by supply bottlenecks. So monetary policy may not be the only game in town to be able to control inflation under such circumstances. Therefore, you have to also work on the supply side of the economy. And if you look at the minutes of the Indian RBI's minutes from the last meeting, you will see that all members of the RBI, the Monetary Policy Committee, say that now the main concern for the policymaker for the central bank is not growth, but it's inflation. So inflation has eclipsed growth concerns. So therefore, almost in unison, you will see most central banks, both in emerging market countries and in advanced economies, are all singing to the same tune that inflation is rising. We need to do something about it very quickly. And therefore, what you see is that policy rates are either going up or staying the same. They're not coming down. So that is where we are now. Higher inflation, that is an internal imbalance that is generating in the economies, and we'll talk about it. So that's where we are, right? So now the other issue that everybody is talking about is that, well, inflation is definitely going up. What else has happened? Well, the fiscal policy has been tremendously expansionary, right? Tremendously expansionary. So not only in emerging market countries, not only in advanced countries, but in emerging market countries. So we are seeing government debt rising rapidly. Government debt rising rapidly over the past 2 years because of the fiscal support that has been provided to the citizens, to the corporates, to the households, corporates, as well as the government themselves have borrowed a lot. And you can see that India has moved to the right, right? You can see way, on the right-hand corner. So India's debt to GDP has gone around 90% of, GDP is debt now, and the fiscal deficit is in the vicinity of, the total consolidated fiscal deficit is in the vicinity of about 10%, although the federal is central government is about 6 to 7%, 6.5%. So this is the story of the recovery, right? The recovery has been significant, huge policy support. Economies were recovering, but this recovery was quite fragile, right? This recovery was quite fragile. And then when it was hit by another shock, the supply shock, what has happened is that for countries like India and many other countries in the region who are net oil importers, for them, what is happening is that their oil import bill has been going up with commodity price shock, with crude oil prices going above 100. On top of that, globally, what is happening is that commodity prices, food prices, oil prices, gasoline prices, all the headline inflation has been going up very rapidly. And what that means is that the Fed will put on the brakes probably even more significantly, which means global liquidity will shrink, global financial conditions will tighten, and that would mean that capital flows, which are hugely affected by such global financial conditions and interest rate movements, as the Fed hikes, money will go back to the US. So you may see massive reversals of inflows of capital. And you're already seeing a lot of the capital that came back in during the past 1 or 2 years during the recovery is again leaving emerging market countries, notably the net oil importers. They're seeing a reversal of these flows that came in. So this is sort of the context where I want to begin our narrative on, how to think about capital flows and put it into perspective, based on what we learn in economics. So that's where I would, and let the next slide shows you that many of the emerging market countries are now in this very left quadrant, which is the quadrant where you have what we call the twin deficit. Twin deficits are not something that you yearn for. You would rather not have twin deficits, which means you have a current account deficit as well as you have a fiscal deficit. There, India is also, you can see India being part of that current account deficit and fiscal deficit. The current account deficit in India is not that big right now because it's just after a year of surplus, it is coming to a small deficit. But the trajectory going forward with the kind of oil prices we are seeing, with the kind of commodity price surge we are seeing, we are likely to see a significantly larger current account deficit going forward. And also the fiscal deficit will likely to stay pretty large, as we continue to, provide fiscal support to the economy. So the monetary policy may have to be much more tighter because it has to, weigh in on the inflationary pressures. So that's sort of the stage that I wanted to set up before we got into the economics of capital flows. So maybe I just take a pause here to see if there are any questions from the audience. And I would really encourage questions. Yeah, I really much rather do a hybrid or a face-to-face because, there's often a lot of silence on the other side when you are doing a virtual lecture like this. But it would be great if there are any questions. Any questions? Maybe there are some questions in the chat or?
So we'll be taking questions at the end as well. So I think
you'll be taking questions at the end. Okay. So, all right. So here's the next slide, which is just showing where we are from the point of view of India's current account deficit. And you can see that there was a moment of current account surplus in 2020, 2021, the fiscal year. Of course, the current account surplus is not reflective of good economics or situation. It is just reflective of the fact that the economy went through a massive downturn. When you have a massive downturn, what happens? You have imports that go down significantly, and as a result, the current account balance sort of technically becomes your trade balance sort of drives the current account balance to being positive. It's mainly because of massive decline in imports relative to exports, and that is sort of the story. But now, as you see going forward, you're likely to see the current account deficit, current account balance shift to a bigger and bigger deficit. India is structurally a current account deficit country because of various reasons. There are two ways of looking at it. One is sort of looking at the components of current account balance, like oil, gold, other import components versus exports. That's one way of looking at it. And now what we see is that the current account balance is going to shift more because the oil bill is going to go up in dollar terms. And as the oil bill goes up in dollar terms, you're going to see a massive increase in import bill, and that would eclipse your sort of surplus to going into more of a deficit. The other way to look at this is from the savings investment balance perspective, and I'll get into this more, but just to say for now that you see on the right-hand side graph, there is this, the current account balance is mirrored by the public savings investment balance and the private savings investment balance. What has been driving India's current account balance structurally has been the public savings investment imbalance and the public savings investment dissaving, basically. So large fiscal deficits over years have had a negative impact on the current account balance, and the current account has been on a deficit for years because public savings is dissaving is greater than private savings. Okay, so that's sort of the story. I'll come back to this more. Okay, now that we have some of the numbers and I've given you that narrative, let's link this to a bit of economics. How do we as economists think of these things and put things into perspective? Here, it's very important to understand that our main role as economists is to assess where we are in an economy at any point of time, right? And we then forecast and see where we are going to be in, let's say, the next year or so. And based on that, we need to adopt a set of policies. So under the current circumstances, of course, the economy was during the time of COVID, the blue line, you can see a massive downswing. You could probably, redraw this line to being a massive downswing where you were way below your potential growth, the long-term potential growth, where inflation was having a downward pressure, where, the external imbalance were also not that significant. But then suddenly you have these imbalances growing with the supply shock. So you have aggregate demand going up, but at the same time, you have supply shock not moving to the right, but actually moving to the left, which means it amplifies your overall internal and external balances. You want to always bring your economy back to where the blue line intersects the red line, right? That's where aggregate demand is equal to aggregate supply. The economy is on an even keel. That means neither you have inflationary pressures nor do you have external imbalances. So as economists, we really need to look at what we call the internal imbalance and the external imbalance. Okay, the internal imbalance is your inflation shortfall from potential GDP or higher GDP than potential, unemployment or wage pressures on the contrary, or you have external imbalances, which are large current account deficits or even large current account surpluses, major outflow problems because of balance of payments pressures, or major inflow issues from balance of payments inflow pressures, unsustainable external debt. So as economists, we always want to look at these two imbalances and put things into perspective and analyze them and see, where is the economy now? Well, what we are seeing is that internal imbalances are rising. And external imbalances may also be driven by some of these internal imbalances, and I will explain a bit more when we go forward. So ultimately, as a policymaker or as an economist, your role is to assess these imbalances currently where they are, and sort of suggest first make an assessment and then suggest how policy adjustment should take place to correct for these imbalances. Because what happens is if you keep these imbalances for too long, if inflation were to continue to rise for too long, then ultimately what you may see is that the economic growth, is impaired. Your income, per capita income in real terms will decay. Your purchasing power will go down, and basically the economy will go into a spiral, where a wage price spiral, whereby maybe a massive inflation shock, which will remind us of the 1970s, especially in Latin America, where people, as soon as they got their salary, they went out and bought goods and services right away, because they know that if they wait long enough, they won't be able to, the purchasing power of whatever they got would decay over time very quickly. So internal imbalance is a very good, important ingredient to manage. On top of that, you have external imbalance, and they are interlinked. And what I want to show you later is that how they're interlinked. So how do you manage these kind of interlinked of imbalances? Well, you have fiscal policy, you have monetary policy, you have exchange rate policy, you have pricing policy, and you have structural policy. So right now, what you see out of all the Fed or the RBI is that the policy narrative is more about, well, what do we need to do now? Well, fiscal policy cannot be too expansionary right now, because aggregate demand is already caught up, and we are sort of at a potential growth, and maybe that's pushing to output to too much higher, and we may be overheating, the economy may be overheating. Therefore, fiscal policy and monetary policy for sure has to be much more contractionary. So interest rate setting will have to be designed in a way that your policy rates, the repo rate, continues to go up, so that markets have the notion that the central bank is on top of its game. It's going to address inflation. It's not going to lose its credibility. Inflation will continue to be moderate going forward. It's not going to go beyond its target. So what we see currently, I think in India, the inflation rate is about between 6 to 6.5%, and the inflation target for the RBI under the inflation targeting mandate is the upper end. The tolerance level is 6%. So indeed, you are pushing against that tolerance level of the upper end of the target, which means that if you don't do anything to policy now, if you don't tighten monetary policy, you're going to continue to get inflation that is higher than your tolerance level, and the central bank over time may lose its credibility and its handle on inflation. So that is a very important ingredient right now in the policy dialogue. Of course, the monetary policy is very intertwined with exchange rate policy, right? If you lose your inflationary mandate, and you lose the investors think that your inflation fighting ability has been impaired, then quite often they will start, investors will be very, very jittery about investing in Indian markets. And what you may see is that the financial markets, the asset markets, will have a significant negative impact out of this. And the exchange rate being one of the key indicators of that, you would see a depreciation of the exchange rate, which may fuel further inflationary pressures, because imported inflation may go up. So these are things that you have to think about. And of course, right now the supply chain issue is more of a structural policy, whereby trade linkages, shipping lanes, supply of computer chips, labor shortages. These are structural issues that need to be handled with care to be able to have aggregate supply and aggregate demand mismatches to be closed, so that your economy is on that potential rather than either above or below. So that's what policy is trying to do now. Without going into the next slide, I'll go to the very simple identity, the national accounts of current account balance. basically, it all boils down to current account balance is the summation of public savings investment gap and private savings investment gap. That's the SP minus IP, and SG minus IG is the public savings investment gap. Therefore, India's story has been that the current account balance has largely been driven by the public savings investment gap more than offsetting the private savings investment surplus. So the story has always been that way, that the public sector's deficits year in, year out has driven current account balances to deficits, whereas the private savings has been more in the surplus, more than offsetting, not more than offsetting, but the public saving has been more than offsetting the private savings. Okay, but going forward, we are likely to see that the private savings surplus is going to go down, because clearly, inflationary pressures, higher energy prices, higher commodity prices will also hit households, consumers, businesses alike, and that will have an impact on their savings and the ability to invest in the economy. So that is sort of another element that will likely put some pressure on the current account balance, and which will end up being a much more amplified balance of payments pressure, which can have a huge impact on the economy going forward. So that's sort of the mechanics of this. You can think of this both from a savings investment angle for a country. Therefore, it is very important for countries, emerging market countries, as they move from much more developing countries to more developed countries, they have to, as their per capita income increases, there are safety nets where private citizens save money, and they have a higher savings rate. Corporations save money out of their profits. So the private sector would drive a lot of the savings investment imbalance, but at the same time, they would also be sort of investing part of the savings, part of their income, so that the country can continue to sustain its economic stability and growth. But at the same time, fiscal has to become much more, over time. Fiscal will probably have to be more supportive of the overall balance of payments pressures. That way, fiscal consolidation over time will have to be an important ingredient going forward for India. But currently, India is not in any shape or form to have a significant fiscal consolidation given the situation we are in. India was doing pretty well on fiscal consolidation, after the GFC for a certain period of time. But then again, with COVID hitting, India's fiscal policy has become much more expansionary. And that has also partly contributed to the current account deficit. Okay. So basically, here is another important thing that I want you to understand. When you have a current account deficit like India, it is not that the deficit in itself is bad. It depends on how you are financing that deficit. Take, for example, the case of the US, right? The US has been one of the largest current account deficit countries globally, right? But it has not really had a huge pressure of that current account deficit, sustained current account deficit, leading to a BOP crisis, or leading to a dollar crisis, or leading to macroeconomic instability. Why? Partly because the main reason is because the US can always attract, given its deep financial markets, given its institutions, it can always attract capital to be able to finance its current account deficit. So it's this identity is very clear, right? If you have a current account deficit, you need to be able to finance that current account deficit. And how do you finance that current account deficit? Through capital flows, right? Through portfolio flows, through foreign direct investment, or through other investments like loans. Okay. In India's case, India has had a sustained current account deficit. And initially, when India was, in the bottom of the developing ladder, it had access to a lot of official financing, which was concessional. So that was the sustainability of the deficit was not questioned. But over time, as India became more developed and India could not, its per capita GDP went above a certain threshold that India could not get much development assistance, the fiscal, India became a market access country. That means India's government, when it has a fiscal deficit, how does it finance its fiscal deficit? It finances it by issuing marketable securities, right? And these marketable securities can be bought domestically by households, firms, or financial institutions, or it can be subscribed to by foreign investors. The issue is, if foreign investors are financing India's current account deficit, if foreign investors, that comes with a premium, right? If foreign investors see that India's fiscal situation is getting worse and worse, its macro stability is getting worse and worse, its internal and external imbalances are getting worse and worse, then they will demand either a higher premium on, let's say, on government bonds that they buy. They may want a higher yield on it, or if they're buying equity, they may also want a higher equity risk premium. So overall, as foreign investors become part and parcel of your financing your current account as your capital account opens, you have a much more challenging situation, but at the same time, you're diversifying your financing base of your economy. Because otherwise, it would be domestic investors who would have to always finance the current account deficit, fiscal deficit. That can create what we call we call it crowding out, right? So that's the mechanics of this. The most important thing is, how do you finance the current account deficit going forward, as India's current account deficit is likely to continue to grow to a bigger and bigger deficit in the next year or two. To the extent that you can finance it with debt and equity flows, you are okay. But as these debt and equity flows are, if they're portfolio flows that tend to be hot money short term, more than FDI that is long term, or maybe even loans to some extent, then your volatility can become so significant that at certain points in time, your current account deficit may be almost unsustainable. And that happens, when that happens, your macro adjustments will have to kick in, which means growth will have to go down, imports will have to go down. That means the economy will suffer a massive downturn. So adjustments are tough. If you want adjustments, you must, if you do not want adjustments, you must have the economy on that red line, right? The blue line crossing that red line, where internal and external imbalances are sort of managed in a way that they are not going above or below. So that's why it's important to understand the concept of capital flows in the overall issue, that capital flows can finance an economy to the extent that the economy is able to absorb those capital flows, and investors are willing to finance you even at a higher premium if need be. But sometimes when we call it sudden stop, like the very first slide, what we saw, investors at a certain point may think that the global situation is so dire, so difficult, it's called the risk-off scenario, where they take all their money out from emerging market countries. That's when your current account deficit cannot be financed anymore, or the budget deficit cannot be financed externally, and therefore you have to have a massive adjustment of the economy, and the economy goes into a recession. So that's sort of the overall dynamics. Let me give you a second to think about this while I turn on my light, because here in Kuala Lumpur, the sun has set. So I need to turn on the light. Give me a minute.
Students, you can start typing your questions in the chat box till then, yeah?
The sunset is very nice here, but there are some ominous clouds behind the sunset, which is also speaking of the current situation in the economies. So this is how the intermediation happens in the global capital flows world. So you have the recipient country, financial institutions, which are in the yellow, the local banks. But of course, we will see later that the local banks have also been sort of replaced by what we call now market finance. So a lot of the funding of emerging market assets are, the assets of previously. What would happen is that the current account deficit would significantly be bridged by through what we call other investments, which are loans, right, for project finance or for whatever it is, through loans. But over time, after the GFC, what we have seen is that emerging market countries are increasingly moving towards what we call market finance. So before, maybe the government would borrow through the banks from the external global savers, global banks. Now the government, whenever it borrows, it issues debt, right? Government securities, and these securities are subscribed to by global savers. Let's say a pension fund from the US would buy Indian G-Secs at a yield of 5 to 7% or something. They think that they are getting a higher yield, higher return on their investment, but of course they are taking a currency risk there, right? On the other hand, before the global financial crisis, a lot of emerging market countries used to issue debt, and before the Asian financial crisis, they used to issue debt in dollars, because foreign investors will only buy emerging market debt or equity if they're issued in dollars. They didn't want to take the currency risk. But since the Asian financial crisis and the development of the financial markets in emerging market countries, what we are increasingly seeing is that, let's say, Tata, or let's say, a big Indian Maruti or somebody, wants to borrow money, does not have enough capital, they will borrow before it would go, borrow cross-border from cross-border banks like, say, Deutsche Bank or JP Morgan or Citi or the like. Now, a lot of these corporates will actually, instead of borrowing in the lending market, they will issue corporate bonds. And a lot of these corporate bonds are in dollars. And these dollar corporate bonds would be subscribed to by foreign investors. So we are seeing an evolution of how the emerging market capital flows is changing. Before, it was highly intermediated by global banks to local banks through global savers. Now the global savers are putting money not through global banks, but through global financial markets into, also most often than not, global banks are also involved, because banks are the ones who really make this market. They are intermediating this capital, but they are actually buying emerging market securities rather than basically lending money in the traditional sense of loans. So that's what is happening in the global financial intermediation. Yeah. Okay. So what does this mean? Well, it means that local borrowers are exposed to, of course, they have the credit risk because they can default. They're exposing global savers to that credit risk. There's that market liquidity risk is also there, because what happens when these markets of government bonds or corporate bonds sort of they freeze because of investors pulling money out, then it's very difficult for investors to actually liquidate their assets, because these markets become very illiquid. So in the US, that's not the case, right? If I am financing let's say, the Indian pension fund is investing in treasuries, US treasuries or JGBs in Japan, that market is very deep. That market is very, very liquid. They can anytime sort of sell their assets and bring the money back. And of course, the dollar is a global reserve currency. The dollar, you can always get dollars. Whereas here, if an American pension fund wants to liquidate their assets in government bonds in India or in Indonesia, they will first have a tough time selling those assets in a market, in a stressed market situation. Second, there is no liquidity sometimes. The other issue is that they want to probably bring that money back to in dollars or in euros or in yen. There is an FX liquidity risk on top of that because they're taking the FX risk. So there are different layers of risks involved. The exchange rate risk has been shifted to global savers from the emerging market borrowers, but at the same time, global savers are becoming increasingly more aware of these kind of risks. Therefore, they may pull their money out at the drop of a hat and say, "Oh, I don't want to take any more FX risk now because market conditions are deteriorating." In fact, we have seen a lot of these things happen over the past two to 3 years. We as economists have really, we think that it's great that emerging markets can now borrow in their own currency from global investors, but global investors now face the brunt of that FX risk, right? So they have to either hedge that risk or be able to continue to stay with it until the market's quite enough down. But for many investors that are leveraged, they cannot do that. Anyway, let me not go into all of that for now. So here is sort of the upshot of this. What is the upshot of all of this? Well, first, emerging markets have become much more financially integrated. Therefore, capital flows are, money is moving from one country to another, financing their current account deficit and fiscal deficit. Monetary and financial stability shocks in advanced countries have become much more important transmitter of shocks to emerging market countries. So if Chairman Powell gets off from the wrong side of the bed and says taper, then what happens? There's a huge tantrum across the globe, right? Emerging market policymakers think, oh boy, if the Fed is going to taper its balance sheet, reduce its balance sheet, or raise interest rates, that means money will flow back to the US, whatever money was being invested in emerging market countries. And when money leaves emerging market countries, what happens? What is the first thing that happens? As capital flows out, it has a huge impact on currencies. It tends to depreciate currencies as capital flows out, right? So and the depreciation of currency right now is a big concern. Why? Because if currencies depreciate now, then already inflationary pressures are going up, then imported inflation will go up, because as currencies depreciate, your import costs go up, right, in local currency terms. So therefore, that pass through to the local inflation becomes much more significant. So you have to strike the right balance. Policymakers have to think about this issue that, oh, wow, the Fed is going to raise its rates. It's going to, reduce its balance sheet. What should emerging markets do? Well, it can raise interest rates. That's one thing. What else can it do to manage this volatility, to manage the transition, to manage inflation risk, becoming much more amplified? So it's not a very easy solution by just raising interest rates. And that's why, my next few slides will talk about what we call, over time, what we have seen is that managing your policy framework, as the world has become much more integrated, more complicated, the policy framework has also become much more, has to become much more robust. So it has to become much more flexible. And I'll talk a little bit about that in the coming slides. And what you see is that on top of this, you have this market finance, right? You have a significant amount of money quickly moving in and out as global pension funds, global hedge funds, global private equity, sovereign wealth funds put money into emerging market countries, and they quickly take that money out if they see some risk out there. And that makes the financing situation in emerging markets much more volatile. So the onus is on central banks and policymakers, fiscal monetary policymakers, to ensure that investors are more comfortable investing in emerging market countries, right? So let's say a central bank says, oh, as our fiscal deficit is going up rapidly, I'm just going to call the central bank governor. The finance minister says, I'm just going to call the central bank governor and say that, look, we are going to raise a lot of market borrowing. I want you to keep interest rates low, and I want you to buy a lot of our debt. What does that mean for investors? That means inflation, its monetization is bad for inflation. Your credibility as a central bank, you're not independent, your credibility is lost, and therefore markets will start thinking twice before funding your deficits, or they may ask for a much higher premium if they want to invest in your country. So monetary policy frameworks or policy frameworks have also evolved to stay apace with these kind of evolutions of the financial markets. And that's sort of front and center. And at the CSUN Center, we're doing some work on this right now on capital flows and policy frameworks. So the next slide basically says that, all these complications or, the evolution is making our basic macro thinking much more complex. And one of the things that is most important, and this was, when I was in the early days in the IMF, we don't call it macro anymore. We call it macro financial. Why? Because macro and finance has become much more intertwined. Finance has become very much part of macro. Why? Because here is a pension fund sitting in Washington, D.C. saying, oh, I can get higher returns by investing in a bond fund that has Indonesia, that has India, that has Philippines in it. But I'm going to only invest, through a market instrument like an ETF or something called, the exchange traded fund, which sort of invests money just like in an equity market where the bond fund has a daily price and I can put money today and take money out tomorrow. But the problem is that quite often when you want to take money out, everybody wants to take money out. And when that happens, then there is a sudden stop and the markets freeze and liquidity freezes, and then central banks may end up losing a lot of reserves because by supplying the reserves as these funds try to redeem, your amplification becomes big. And that amplification can create massive distress. You are seeing in Sri Lanka's case right now, right? Sri Lanka was doing reasonably well. Of course, it had a lot of vulnerabilities, but Sri Lanka has issued a lot of dollar debt because investors are not very keen to buy Sri Lankan local currency debt. So Sri Lanka ended up issuing a lot of dollar bonds, sovereign bonds to foreign investors. And a lot of foreign investors, are part of this, investment community that has invested in Sri Lanka. The key question for them is that, is Sri Lanka going to survive this huge balance of payments crisis that is going on, right? It's really heart-wrenching to see what they're going through right now. And the governor is a good friend of mine, and it's just really hard to see. He has just been placed there. He is one of the big proponents of CSUN, and his work is cut out now because the political situation is so bad that the onus falls a lot on the central bank to manage this risk. So when you have massive fiscal deficits that you're financing through dollar bonds, and foreign investors are not willing to hold them, then what do you have to do? You have to shrink your balance sheet, you have to shrink your economy because you cannot finance it anymore. That means there is no money to have a deficit. You have only, either you can monetize your deficit by printing money, which means higher inflation, which is what they have been doing earlier. But of course, this is going to stop if they want an IMF program to bridge the gap. So what happens is that as money flows out, you monetize. When you monetize, what happens? You basically, given reserve money, your I'm going to say this, NFAs, net foreign assets and net domestic assets. This is IMF terminology. This identity will tell you that given reserve money, if you continue to monetize, you're going to lose a lot of reserves. So that's what has happened, that they're down to almost the bare bones of reserves. So that's where Sri Lanka's situation is very difficult. It's a classic emerging market situation where your imbalance is driven to a large extent by fiscal deficits, running large fiscal deficits that is being financed externally. And when the music stops, nobody wants to finance your fiscal deficit. Then you say, the central bank will have to finance it through its own money printing business. And that has a huge negative impact on the currency, on the balance of payments, and so on and so forth. So as a result, they are under a very, very difficult situation now. And in fact, they have sought for programs with India because India is giving them, you at the end, you need a lender of last resort in dollars. And somehow India, given its large reserves and other, to maintain its relationship with Sri Lanka, has been providing them some kind of a backstop. But at the end of the day, they need a large amount of dollars to be able to sort of repay its massive 7 billion or so outstanding, coming up debt outstanding, and they're already in a default status. And that's not good for Sri Lanka because they have never defaulted before. And defaults such as this will leave a bad taste with foreign investors. Okay? So that's where we are. I'm not going to go through this anymore because I want to leave some time for questions. But again, the bottom line is that US dollar borrowing comes with its risks. Okay? And the dollar funding market is a very big market. It is the massive market, globally, be it any sovereign outside the US. The dollar is the biggest reserve currency, and every sovereign is involved in the dollar funding market. Even if you think about a country like Germany, right? Germany is a net current account surplus country, right? Even then, Germans need to invest their money somewhere, right? They need to invest their money. So where do Germans invest their money? They cannot invest only in the German bonds or the European securities because that market is not that deep. So quite often the excess savings are shipped off to buy US financial instruments, which closes the US current account deficit gap. And that creates its own difficulties, because if you are a German, your assets are in savings are in euros, so you want to hedge that euro risk. So therefore, when you invest in dollar assets, you will need to hedge that. So therefore, you borrow in dollars. So this is a complex issue. I don't want to go into it, but the dollar funding market is one of the biggest markets now, and Indian corporates borrow a lot of money from the dollar funding market. So that's something to be kept in mind. And the other thing is that since the global financial crisis, what we have seen is a huge increase in the domestic debt markets in emerging markets. The emerging markets have begun to issue a lot more debt in domestic currency, which has been bought by foreign investors. So increasingly, as the domestic debt market has gone up, in China, it has gone up by leaps and bounds. And there, a lot of foreign investors coming into China because China is going to be was included in the global benchmark indices. And if you're a benchmark investor, you will have to invest in China to stay within your tracking error of your investment. So basically, what you see is a huge expansion of the debt markets in emerging market countries where foreign investors are coming in increasingly. India has been very careful about it. India opens up its domestic debt markets to foreigners in a very, very calibrated manner because it doesn't want to face the wrath of foreign investors suddenly pulling out all that money and then having nowhere to finance. So India has been very careful on that. But the next slide really does show that the foreign ownership of local currency sovereign bonds has gone up a lot, including in Asia. Okay, and what that means is that global conditions can quickly amplify and be transmitted to local conditions because foreign investors, when they buy a lot of local bonds, currency bonds, and they suddenly face a shock, global shock, they want to dump these bonds, redeem them, they pass it on to either local investors buy them or local banks buy them, and that creates its own challenges that I won't get into, but that's another probably lecture called the sovereign bank nexus. Anyway, so that's where we are. Last but not least, just to mention that in conclusion, you have to have a good understanding of what are the transmission channels in the international markets. What happens to the exchange rate when these kind of financial integration takes place? Exchange rate is an indicator of trade competitiveness, right? If the exchange rate appreciates too much over time, then you become less competitive. Therefore, you do want to keep your exchange rate at a level which is trade weighted. This is about a trade weighted real effective exchange rate, which is competitive. If it's not too competitive, then your balance of payments will have some pressure. It will also pass through the currency depreciation, will pass through inflation. And of course, the big channel now is the financial channel that I was talking about, right? And the financial channel becomes even more important during periods of crisis. When everybody wants to run, you see massive fallouts in the financial markets, and the exchange rate also has a repercussion. Currency depreciation becomes not just, it doesn't become a positive thing, because usually a currency depreciation is good for your trade, right? And in this case, when you have balance sheet exposures, a currency depreciation can become very, very debilitating for your balance sheets, because your liabilities that are denominated in dollars become much larger in local currency terms. So that's what happens. So the largest spillovers of financial conditions can happen because, not because of something you did, but because the Fed is doing something, the ECB is doing something, or the likes. So we are much more interconnected, which means we can bring in capital to diversify our risk to finance our economy, but we need to do it with caution, we need to do it with diligence, we need to do it with circumspection, so that that money that comes in to finance our economy is more long-term in nature, it's more durable in nature, and doesn't flee at the drop of a hat. That's a very important balancing act to play. And for that, you need good institutions, good central banks, good fiscal discipline. But as we know, the COVID crisis has sort of put a dampener on many of these kind of issues for now. But over time, as we recover, this will become a very important issue for emerging markets to be able to gain their policy footing back. So the last slide sort of talks about a lot of seasoned member economies, India, Philippines, Malaysia, Indonesia. They use not just monetary policy to manage capital flows. They have been using capital flow management, foreign exchange intervention, macroprudential policy. We do not have time to go into this, but it is, I'll just give you one example of maybe a more developed country, like Singapore. I used to live in Singapore for a long time. Singapore has this thing where it's, of course, a current account surplus country, net capital exporter. But Singapore has this, a lot of Indonesians, Indians, Malaysians want to invest in the Singaporean housing market. So Singapore used to see a massive inflow of capital into its economy to buy houses, like in the housing market. But what does it do to the domestic economy? That means it puts upward pressure on housing prices. And that sort of becomes a political issue at some point, because if it continues to rise, affordability becomes lower, and the local citizens become much more disenchanted, and they start, writing big blogs, talking about how unaffordable Singapore is becoming. So their policy has to step in to mitigate these inflow risk of capital flows, which is creating higher valuations for housing. There, what you want to do is that you can use certain macroprudential measures on housing to be able to mitigate that risk. The step further is what you do is called capital flow management, where you say that, oh, if you want to invest in our housing, if you are a non-resident, you will have to pay a 10% tax, higher tax than a resident. Then it sort of disincentivizes or increases the cost of investing in Singapore's housing. So those are sort of measures that different countries are taking to be able to manage this inflow and outflow of capital. Why? Because most of our countries in the region, apart from China and maybe India to some extent, compared to the global sort of pool of money, is much smaller, right? So even if some money is coming in, that can create significant disruption for your financial markets and your macroeconomy. So you need to manage that very well. And therefore, it is very important to have a consistent framework to be able to manage capital flows that is integrated with your monetary, fiscal, and structural policies. And there, I think the IMF's institutional view on managing capital flows, it has been a bit behind the curve, but over time it has continued to catch up. While the ASEAN economies, the CSIN economies, have been practicing a lot of these things using their tools of macro flow, capital flow management to effectively manage capital flows. So let me end there, and I hope that this has, at least piqued your interest on this hot topic of capital flows. Believe me, it will remain front and center for all emerging markets going forward. So let me stop sharing here so that I can see the faces, or if anyone is at all.
So we have a couple of questions. Should I read them out to you?
Sure. I'm going to sip some tea while I'm doing that.
Right. So I have a question from Spandan. As instability in the US economy increases with respect to the rest of the world, do we expect capital outflows from the US to countries like India? Or do we expect foreign investors?
The first line? Sorry, could you repeat that? As the first line.
As instability in the US economy increases with respect to the rest of the world, do we expect capital outflows from the US to continue, US to countries like India? Or do we expect foreign investors to flee back to the US Treasury bonds?
Thank you for the question, Spandan. I think I am one of your advisors for your dissertation, so I think maybe you can expand on this later and discuss this. But here's the thing, capital flows to emerging markets are driven by what we call push factors and pull factors, right? What are the push factors? Push factors is what pushes money out of advanced economies into emerging market countries. What can push money out? Well, money can be pushed out if the yields in US investments are very low. If you're getting 0.2% on a treasury, you want to get the 7% yield carry in a Indonesian bond or Indian GSEC. So basically, the push factor is driven by, low policy rates or low investment rates in the US. That could be one factor. Of course, political instability or general instability in the source nation can also push money out into emerging market countries. But generally speaking, the pull factors are the factors that tend to pull money into emerging markets. These are growth differential, interest rate differential. If India's growth differential vis-a-vis the US is much higher, then clearly money will come. It will have a pull factor, and interest rate differential is another, because you have a higher yield in India that would pull money into India. But at the end of the day, when global instability, not just instability in the US, when global instability rises, what you tend to see is that there is always a flight to safety. And the flight to safety is generally in the reserve currency, with deep financial markets, with deep and liquid financial markets, and the global lender of last resort, basically. So typically during periods of global geopolitical instability, you are likely to see the dollar appreciate because money flows back into the US, not because of growth differential or interest rate differential or other factors that are pull and push, but they are basically coming out of this whole safety, safe harbor, basically, wherever money is safest, deepest markets where you know that you can get your investment back. But of course, this can be debated in the context of sanctions and all these things. Maybe some countries now may be a bit more reticent to even save money in dollars, to say that, well, what if my country faces sanctions? Will I be able to get my dollars back or not? That's a different set of issues. But generally speaking, capital flows typically will be driven by these push and pull factors. But when all bets are off, given the global conditions become systemic in nature, like the GFC or the like, money will typically flow back to the safe haven, which is be it the euro, be it the dollar, be it these countries. And remember, many emerging market countries, including India, still have something called capital controls, right? So during global periods of instability, investors may think that, wow, what if it's like Hotel California, I can check in, but I can't check out, right? So whereas the US, we know that it is always been an open capital account. It's a fully convertible currency. You can always liquidate deep markets. You can redeem your investments. So from that point of view, it is always one way when global instability rises.
Thank you so much, sir. So the next question that I have is from Divyam. Thank you for the great session, sir. I'd like to know what your opinions on the recent increase in India's merchandise exports, whether your outlook for the same is positive in the next few years, and could it help reduce our current account deficits?
So, yeah, to be honest with you, I follow India from a distance, and I can just give you some very broad assessment of it. I think in the near term, on balance, the risk is more that even if you were to be able to increase your exports of services, or maybe even goods, given quite a bit of manufacturing may have moved to India, it is highly likely that in the near term, outlook is going to be much more defined by the global situation. where we have a confluence of one, we have global financial conditions tightening because the Fed is likely to tighten. Financial conditions globally will tighten, which will have an impact, negative impact on capital flows, which will mean that your financeability will decrease. Okay. On top of that, you have a supply shock with oil prices going up, so input costs are going to go up. Therefore, that's going to have some impact on your manufacturing and some impact on your overall economic growth, which is likely to be, I think there are some estimates which say growth will likely be down by 0.2% of GDP, GDP for every 1% increase in inflation. So therefore, you have that impact of every sort of for every dollar rise in the barrel. Crude oil import price. Okay. So there you have these, the financial channel and the trade channel are competing with each other. The trade channel is likely to be much more complex given the oil issue, and the financial channel is already complicated with financial conditions tightening. So I think the outlook for the next 6 months to 1 year is clouded by these kinds of issues. But that said, maybe India can sort of manage to be resilient by keeping its exports high. But that's a very difficult situation right now with supply chain issues, with the input costs and the likes.
Thank you so much. The next question that I have is from Costa. Hello, sir. On the ground, inflation is alarming in India at this time, but there is no change in interest rates. Is this an acceptable situation? Huge inflation, continually growing, and constant interest rates. Do you think the RBI needs to act on this sooner rather than later?
Yes, well, I shouldn't comment on what are there, but market commentaries are already talking about that. The last MPC meeting, as I said already, everybody in the Monetary Policy Committee agreed that it's not growth, but it's inflation that is primary now objective function. So therefore, you're likely to see the RBI sort of already relaying this to the markets that clearly, we are on top of this game and we are, paying more attention to inflation now than growth. So therefore, going forward, you're likely to see a significant tightening of policy to curtail inflation. But that said, I think they also qualify it by saying that, well, this inflation phenomenon is not driven primarily by aggregate demand pressures. These are driven by supply bottlenecks. Therefore, structural policies, certain policies to ease the supply chain will need to be accompanied by these kind of policy rate hikes. That way, it can deliver a more, a better synergies of the two can help alleviate some of the pressures of the mismatch between demand and supply. So I think it's a combination of not just interest rate rise, but a combination of more, supply chain related measures that can be alleviated that will help the overall inflation picture going forward.
Thank you so much, sir. I have a last question from Abhishek. Apologies if this sounds silly or amateurish, not exactly an expert. Recently, I read that the IMF had accepted some notions of capital control to handle foreign money. I wanted to know what are your views on this, whether it's a welcome change.
So I don't know whether you are talking about the recent board paper on the institutional view, which has evolved over time. I think you are alluding to that. And the recent board paper talks about, well, as I said in my other slide, that the policy framework for managing capital flows has to be much more eclectic, where it not only uses monetary policy, exchange rate flexibility, but it looks at capital controls, foreign exchange intervention, and macro proof. What the IMF has said after a long time of deliberation is that now they're saying that capital flow management measures, preemptive capital flow management measures may be, okay, let me step back. So the original institutional view says that macro first, any kind of macro adjustments should always be first call before capital flow management should be the last option. If your exchange rate is not overvalued, if your reserves are adequate, and economy is not overweighted, then only can you use capital flow management. Now they have gone a step forward to say that yes, you still need your macro to be the first, but in terms of capital flow management, you should be able to preemptively have certain capital flow measures, capital flow / macroprudential measures, provided those measures are directed at ensuring systemic financial instability related issues. So you can be preemptive, but you can only be preemptive if you think that those capital flows can have systemic instability consequences to our economy. And this is a step in the right direction, I would say, in the sense that it is clearly indicating that capital flow measures are beginning to become part of the policy package in its entirety.
I know I said last question, but there's another question
absolutely.
that came in. RBI has, this is from Dhruvi, RBI has been critiqued to be behind the curve. However, after the revised measures taken by the MPC, it's believed that the situation will be tackled well. What are your views on RBI being behind the curve?
Well, again, it's very difficult to, I don't follow, like the markets follow. So I will just say what the markets are saying. And in fact, I was just reading the market views earlier. And indeed, the market is already sort of talking about, the RBI being on top of its game. And, basically the last MPC statement when it was made public clearly showed that the confidence in the central bank regarding, forward-looking measures to tackle inflation has increased the confidence. So I'm sure that if you look at if there is like the Fed measure, if there are certain market indicators of futures rates, or you will certainly see that the future rates are likely to go up. And that would mean that the market is already expecting the RBI to tighten more significantly than before. So I think, yes, maybe, it's a very difficult situation, right? Even the Fed, a lot of people say it is behind the curve, right? Because we are coming out of a pandemic, right? There are lots of supply bottlenecks to disentangle whether it's a demand pressure versus a supply mismatch is very difficult. So, in that sense, I think, we were at a situation earlier where if you were to tighten very quickly, where inflation was still sort of somewhat transitorily, it was thought to be transitory. If you were to tighten too rapidly, it could sort of completely, derail your fragile recovery. So it's that balancing act, right? Then the central bank will be blamed for raising rates too early and completely derailing the recovery, versus now seeing that inflation has indeed not transitory, it's much more permanent. Therefore, we must act now. So that narrative sort of has been changing over the past 3 months quite rapidly, on balance towards more inflation, being more inflation fighting. It's not an easy one, because this kind of a shock is a very difficult one to assess. So I can see the central bankers being much more, what should I say? They don't want to make that policy mistake and sort of stifle growth while we're coming out of this massive, dislocation of the economy. But at the same time, you got the war, which was not expected, and that has pushed crude oil prices up, and that has amplified the whole thing. So it's a difficult sort of thing to blame the central bankers for being behind the curve. The shocks that are hitting us are much more unanticipated and really massive. So it's not an easy task.
So I have a follow-up question. Sometime last year, I read an article where they said that the RBI has been increasing their foreign exchange reserves, and the US dollar was standing at 608 billion in June sometime last year. So this prudential, some are critiquing this prudent behavior as counterproductive. So I just wanted to understand whether these ramifications will have some sort of effect in the current scenario.
Okay. I mean, I think it's most important to understand the mechanics of this first. How does foreign exchange reserves rise? Well, when you have capital inflow coming, right? What does the central bank do? The central bank intervenes in the foreign exchange market. Either it can allow, when you have inflow of capital, what happens? The exchange rate has appreciation pressure. If you let the exchange rate appreciate, it can continue to appreciate. That means you don't build reserves. But however, quite often emerging market countries, if the exchange rate appreciation is too rapid, given thin financial markets, you want to step in and intervene so that the appreciation is not as rapid, right? Because if appreciation is so rapid, then you're going to see a loss in competitiveness. Therefore, emerging market central banks are very mindful of that. They often use foreign exchange intervention, especially with imperfect markets, thin markets, to manage that. And when you intervene in the market, what happens? The counterpart is that you build reserves, right? When you build reserves, the automatic counterpart on the central bank balance sheet is what? You inject domestic liquidity. When you inject domestic liquidity, it can fuel inflationary pressures, financial instability. But to the extent that the Reserve Bank goes in and sterilizes that, then you can sort of manage that liquidity injection through open market operations by sterilizing that liquidity. So I think RBI is quite concerned about that liquidity finding its way into financial markets and so on and so forth. So RBI is always very careful, and they end up doing quite a bit of sterilization during periods of such huge inflows. And the other lesson that we learned for emerging markets, what is your limit for reserve accumulation? Well, you can see Sri Lanka has run out of reserves. Basically, sky is the limit for many emerging market countries. There is a cost to it, of course, because the carry cost of intervening, and because you have US treasuries yielding 0.2 and the sterilized instruments of Indian government bonds yielding 7% on the liability side, you have a negative carry. That means over time you will be accumulating losses. But that's something that a central bank can manage, in the sense that that can be managed. But on the other hand, you cannot really, building that reserve is very important given the global interconnectedness and vagaries of global policy shocks. Therefore, any central bank governor would probably always, emerging market country, which is not a dollar reserve country, will want to have as much dollars as possible, which we call reserve adequacy, to the extent that it can save for the rainy day. It is saving for the rainy day when it is needed. So I think my sort of, I come out a bit more, on this side, where I have quite a bit of sympathy for emerging market countries accumulating dollar reserves, because you can lose $30–40 billion in a heartbeat. And we have seen that happen in China. We have seen that happen in Brazil. We have seen that happen in Indonesia, and to some extent in India. So I think on balance, central banks in emerging market countries, market access countries, tend to be much more on the side of increasing reserves rather than not. during inflows of capital.
All right, so thank you so much. I believe we've run out of questions. I would like to thank you for this insightful talk on capital flows and the macroeconomic impact on the EMEs and its impact on the rest of the world. It has certainly helped us understand how the macroeconomic variables are at play, given the fact that the world is going through a huge disruption in all facets of our life. I believe thinking about these problems from a policy perspective and its outcome is very important, and I'm glad that I could understand this in depth. Supply shocks has been the talk of the town for a really long time now, and as economists, it is paramount that we understand the ins and outs of dealing with these economic problems, even more so at this juncture in time. And understanding this disruption from in the EMEs from a policy perspective also becomes imperative. Thank you so much, sir, for your time.
Thank you very much. I really enjoyed the questions, and I hope we can see each other in person sometime. And you're a great group, so keep it up and ask a lot of questions, be curious, and also look at the world, not just in India, because a lot of these questions and learning of economics that we are still learning can be done through cross-country comparisons, looking at lessons from other countries. So keep it up, and thank you very much for a great group listening in. So enjoy, and I hope to see some of you in the near future.
Thank you, Dr. Goswami. I think you really generated a lot of interest amongst the students, and I'm sure they're going to come to you and keep asking you questions. Maybe they can send you a mail if possible, and interact with you if you have time.
Absolutely, happy to do so. Yes, MDAE is very close to my heart.
Thank you so much. Hope to see you sometime at the Academy soon. Yeah.
Thank you very much. Thank you very much. Take care and have a good weekend.
Thank you, sir. Happy weekend.
Bye-bye.